Hello, hello. Perfect.
Let's come together and take a stand. Let the world know who we believe. Lift your voice and help us sing. Is there anybody in the love? I wanna know, do you love mine? Is there anybody in the love? Open your mouth and go. Yeah, yeah. The heavens open at the sound of praise. Demons tremble when we call out His name.
Okay.
Like the fire,
Like, I'm not playing.
I'm not afraid.
She was like, oh, I will be there. I'm like, okay.
It showed its fame. Oh,
Good, good. Everybody's good.
is there anybody in the love?
I always want to know what those conversations are like after.
Open your mouth and call. I wanna know, do you love mine? Do you really, really love mine? So shout it out if you love Him. Open your mouth and call. Oh, if you really love Him. Everybody say change. Say yes. You will. With your person say yes. Say say yes. You will. And when I'm alone, I call Him. And when I need Him, I call Him. He'll be right there. His name is Jesus. Lift it up, say change. Said answer. You answer. Oh, what's His name?
I'm waiting for your cue. All right, all right. Well, as we say in the church house, it's a blessed day in the Lord, even though the day is almost over. So, all of you out there in virtual world, and for those of you who are here, again, I appreciate you taking the time out for our little Bible study that we have going on here. Hopefully this information is helping you. Hopefully, you know, it's something that's not just knowledge, but information that you can put to use, okay? So before we go any further, let's approach the throne. Lord, we're coming to you right now. We're asking in Jesus' name, please clear our minds of anything of the world, and we just want to focus on you, your word, and your instructions that you have for us for being good stewards of your money. We have the right attitude. We understand that this is your money that you are just putting us in charge of. So we're going to ask that you bless the information, that it's being received with open ears, and any questions and things like that, that those questions will be answered so that all of your people will know your schedule and your rules and your guidance when it comes to finance. This is what we pray in our Lord and Savior Jesus Christ's name. Amen. All right. So go ahead. Let's get started. I'm going to pick up. We're doing part 2. The first part, we were mostly talking about investments. The second part, we're going to be talking about life insurance. But what you're going to notice is that some of these concepts interweave. Okay, so we want to be careful about that. And again, I'm saying this up front. There's, and no disrespect for out there, you know, if you have a friend or family member who sells life insurance, you know, a lot of times this is controversial and I'll get in trouble. I don't care. I'll get in trouble with people who sell life insurance because they don't like the fact that I'm giving away all the secrets. I use this example of, you know, you see those specials on ABC where they have the magician come and they do all the tricks and stuff like that. Then they go behind the scenes, behind the curtain and show, oh, this is where the trap door is. Here's where the mirror is. Here's where the puff of smoke comes through, right? magicians hate that guy because he's giving away the trade secrets. You get what I mean? Well, that's kind of how me and my wife are when it comes to finance, okay? So we just want to make sure our people know what's going on, go into any kind of contract with open minds, with open eyes so that they don't get tricked, okay? So one of the first money management mistakes that people make is buying the wrong type of life insurance, okay? Now, I'd like to demystify this. Some people go, ooh, no, I don't like term insurance. That term insurance, my grandmama had term and that term ran out. Okay, I got you. And then there's some people go, ooh, no, cash value, just when I needed my money, they told me I didn't have no money in there and all that kind of stuff. We're going to learn the difference between those two. But let me just simplify this. All insurance is term insurance. By definition, insurance, I don't care if you're talking about life insurance, health insurance, auto insurance, is for a certain term. I'll give you an example, and when I say that, you're going to go, oh, that makes sense. Let's say you're driving a Honda, just a regular Honda, not a truck, just a car, okay? And you love your Honda, and you're driving your Honda for 7 years. You just love your Honda. But 7 years later, you got some mileage on it, and you look at it, and you see this car over here that's a Toyota, and you're like, I really like that car. Your Honda's been paid off. You've been saving money like we talked about. The car payment you used to make for your Honda, you've been saving up in your short-term account so you can buy a Toyota with cash and not owe nobody and not have to hide your car from the repo man, okay? So you go and you get this Toyota. Now, did you have insurance on your Honda? You better, right? But now that you sold the Honda and you now are driving a Toyota, are you going to keep insurance on the Honda? No, that's somebody else's problem. But you're going to put insurance on your. So again, all insurance, say that to yourself, whether it's health insurance, auto insurance, auto and home, which is property and casualty, whether it's life insurance, all insurance is for a specific term, okay? So that being said, let's take a look at this. What I always tell people is don't listen to me, because one of the things me and my wife do is sell life insurance. I'm telling you, right? Don't listen to the life insurance agents that's out there. Do your own research, do your own homework, and that'll keep you from getting ripped off. If you look at this, it says disinterested third parties, meaning people who don't have a dog in this fight. Okay, if you take a look over the last 10 years, you've been hearing more TV commercials and more ads and things like that online. Nobody has, magazines anymore, right? About term insurance and this term insurance. And that. But if you think back, if you old like me, I'm 50, right? If you in your 40s or 50s, heck, even if you in your 30s, you can think back in 10, 15 years ago, you couldn't get nobody to talk about term insurance, right? Now all of a sudden it's the biggest thing. Well, that's because now a lot of financial gurus out there, Robert Kiyosaki, Dave Ramsey, Susie Orman, some of these people that people take these seminars from, they've been exposing, we've been doing it first, but they've been exposing how the industry really works, and people are getting more knowledge. And like we say in the church, when you know better, you do better, right? So you also have Consumer Reports. Now, the thing I love about Consumer Reports is they don't take advertising. Now, nowadays, everything's online. But back in the day when you get Consumer Report magazine, the reason why it was so expensive, like in today's dollars, it might be like $9, $12 for an issue of Consumer Reports, is because you got to help pay for what they're reporting. They don't have ads for Coca-Cola. Why? Because if they test Coca-Cola for its sugar content, let's say, and then they test Pepsi, and it turns out that Coca-Cola is worse for you than Pepsi, they both bad, I'm sure, right? But now Coke is mad at them. They're going to pull that advertising just when they, what they'll do is they'll take a BMW and they'll smash it into a wall at 60 miles an hour. Then they'll take a Mercedes and smash it into the wall. Hey, they're not taking ads from BMW or Mercedes. So if the Mercedes comes out better, they're going to say it. Or if the BMW comes out better, they're going to say it. So again, when you go to Consumer Reports, I don't care if you're looking up refrigerators, I don't care if you're looking up automobiles, or, who has the best cracker? Is it Ritz or is it Saltine, right? Whatever the case might be, Consumer Reports gives you an objective, disinterested third party. They don't care what anybody thinks. They just tested it, right? And so when you research that, Consumer Reports always talks about term insurance is the best way to go versus a cash value type of policy. And then what I also tell people is go to the source. Any state that you're in, I think just about everybody here, obviously, and people in the electronic world are in the state of California. You can go to the California website. It's www.insurance.ca for California.gov. Any legitimate website should end in .gov, okay? And guess what? On the website for the California Department of Insurance that authorizes insurance companies to do business in California. Remember, this is the government. If they say you can't do business here, they can get rid of an agent. They can even get rid of a company, okay? So they have a buyer's guide that's out there. And the buyer's guide is written by the state. They don't care what insurance agents say. They don't care what companies say. They don't care who's running the best commercials. If you got Snoopy on the blimp over the, over the Super Bowl, they don't care. All they care about is this is how the insurance works. This is what, these are what the facts are. So I always tell people, check with them as well. And then I did mention both of these, because most people know Oprah's lady, the financial guru. She blew Susie Orman up. Susie Orman was kind of popular before Oprah, kind of took her under her wing, but Oprah took her to the stratosphere, right? She talks about that. There's an article that I want you to Google and download it for yourself. It's called The 12 Financial Mistakes by Susie Orman. Now, you can tell this is old. This is from like 2003 or something, before she was just Susie, right? Everybody knows her as Susie now, but when she was still Susie Orman, right? 12 Financial Mistakes. Look it up and read that for yourself, okay? And then, of course, Dave Ramsey. A lot of people have taken the Dave Ramsey series. A lot of churches in Orange County, they run the Dave Ramsey series, and people are listening to his radio show and all that kind of stuff. Well, he was saying this back in the day as well. So if you Google Dave Ramsey term insurance, or you Google Susie Orman term insurance, watch some of those little 6-minute, 7-minute video clips, and they do a really good job of breaking down how different life insurance policies work, okay? But this is what I want you to take a look at. This is reality here, people. We're dealing with reality. The theory of decreasing responsibility. Now, when we're young, and again, I just turned 50, so, be quiet, Rodney. When we're young, we tend to have young children. We tend to have higher debts, not always, but sometimes higher debt. We have a mortgage or home expenses, right? So if you think about it, at the very time we have all of this responsibility, most young people in their 20s and 30s don't have a lot of what? Money. So I don't know why they didn't make the green line the money line, but whatever, maybe that's gold, okay? So when your responsibility is the highest is when you don't have that many assets, typically speaking, right? And some of you, your parents were independently wealthy and they set you up, well, hallelujah, right? You carry this on to the next generations, right? But anyway, but what tends to happen is as we get older, especially if you've talked to me and I've shown you how to get on a plan, now our assets, our money, let's just call it what it is, right, starts going up as we're saving in the kids' college fund, as we're saving in our retirement account, as we're getting our short-term account and our long-term account together. The money starts going up, and as the kids get older, hopefully go to college or, start their own business, and they get out of the house, right, when you pay down the debt, or if you listen to me on your mortgage, we can take a 30-year mortgage and get rid of it in 12. I can show you how to do that. You already have the calculator, if you did your homework, in your pocket. I can show you how to do that. But anyway, as you pay down on your mortgage and pay down on your debts and get rid of your debts, your responsibility line starts going down. But your asset line or your money line has gone up. Well, hang on a second. Here's the dirty little secret that the life insurance industry don't want to tell you. As a matter of fact, I'm going to check my tires before I drive off on the freeway to make sure they ain't slashed my tires because they don't like that I'm pointing this out. The dirty little secret is you really only need life insurance for this dangerous period right here where you have a lot of responsibility, but you don't have the assets to cover it. If 20 years from now, 30 years from now, whatever it might be, you have more liquid cash and more assets than you have responsibilities, if you were to die, guess what? Your family is going to get, and the next generations are going to get all of these assets. You are what we call self-insured. At this point, life insurance is a necessity. You might not have $300,000 lying around, so you need a $300,000 life insurance policy in this example. But over here, if you got $300,000 in your retirement account, in your short-term account, you got another $100,000. If you're married, your spouse got another $300,000. You guys are worth $700,000, not counting equity in the home if your home is either almost paid or paid for. We're talking just cash. So why do you still pay every month for a piece of paper that somebody's got to die when they're going to inherit? You get what I'm saying? So people go, wait a minute, I'm not supposed to keep life insurance for my whole life. Exactly. They even call it whole life insurance, right? It's a trap. You either have to pay for your whole life or they charge you so much up front. You might have a young person that's in their 20s And they're charging them $100 a month for a policy that really should cost them about $30. Well, that extra $70 that they've been paying all these years, you get what I'm saying? By the time they get 20 years later, 30 years later, they go, oh, your insurance is paid up. And they act like they did something good for that person. No, they prepaid all that. They better have some insurance for free. So this is what I tell people. If God, I'll use me as an example. If I passed away here, my wife and my kids, my oldest just turned 18, my youngest is 12. So she still has a few more years to go. And yes, we're practicing what we preach. We putting money away for the kids. We're putting money away for ourselves and all that kind of stuff. But the insurance will step in and fill in the gap. Okay? But 20 years from now, then I'm still young enough. I'm only 70, right? My parents are both 80. Thank God they're still both alive, right? So if I go the route of my parents and I'm still alive at age 70, right? At this point, my girls got more money than us combined. You get what I'm saying? So the need for insurance has gone away. So this is what we tell people. You only need life insurance for that dangerous period when you don't have the liquid assets to cover the liabilities that you still have, okay? Once you have gotten to the point where you're self-insured, even if we meet later and you want some more explanation on that term, just write it down for now. Self-insured, once you are self-insured, you can take the money you were paying towards the insurance and pay it to who? Yourself. The same way that as soon as you pay off that car, you keep making that car payment, but you pay it to yourself. So now that brings up this example right here. Now, again, this is an example, but trust me, it's for real. Cash value, and it comes in many different terms. Sometimes it's called whole life. Sometimes it's called universal life, variable universal. You have index universal. So basically, universal life gives you a set interest rate. So you have some savings that's being built. They're combining your savings with your insurance. How many things is that? 2 things. They're charging you for insurance, and they're charging you for savings. Now, let me stop before I go any further here, because y'all, I like to keep this real. Come on. If you walked into the Dollar Tree, which is really the $1.25 tree, which is 25% inflation, we talked about that. But anyway, if you walked into the $1.25 tree, I refuse to call it the Dollar Tree, and you bought 2 items, you just ran in real quick, you needed toothpaste and a toothbrush, okay? And you got your 2 items, and you got up to the cash register, and it was a friend of yours or, just somebody that was pleasant, y'all just chopping it up, just talking, right? And so you go, oh, I got to run, okay? And so you go to your car, you look in your bag, and they have the toothpaste in there, but she forgot to put the toothbrush in there. What are you going to do? You're going to go right back, and you're going to and it's not her fault. She wasn't trying to cheat you. Y'all were just talking, and she put the one in and didn't put the other. As a matter of fact, the toothbrush is still sitting there at the counter. Oh, I'm sorry, put it. So, okay. So if you pay for 2 things, you better get what? 2 things. Simple. I told you, I'm not trying to do like Sister Lightner says, I don't ask no tricky questions. I'm not asking you no tricky questions. All of this makes sense. Okay. So if you are paying for life insurance and you are paying for savings, notice I keep saying savings, I'm not saying investments on purpose. You're paying for life insurance and you're paying for savings or cash value. If you die, you expect your relatives to get what? Both. So if you have a $100,000 policy and over the years you have saved up, let's say $20,000, you're right, but $20,000 into your cash value, if you pass away, you are expecting, ain't nothing wrong with you, you're not crazy, you're expecting your loved ones to get a check from the company for $120,000. Am I correct? In most cases, they will get the face amount. What's the face amount of the life insurance? $100,000. And don't get me wrong, they're going to pay that $100,000. They're not trying to lose their company. They're not trying to go in front of a jury because juries love to stick it to insurance companies. They'll give the poor widow or the kids 10 times what they were supposed to get, right? So no, they're going to pay that $100,000 because the face amount or the death benefit is $100,000. What they'll do is they'll say, oh, well, you had $20,000 in your cash value, and we're going to make up the difference with the 80. So if you pass away, your family will get the $100,000, even though you paid for how many things? 2. And if you borrowed, did you guys catch that? What word did I just say? Borrowed. If something is your money, Vanessa, if you got a $100 bill in your purse, whose money is that? That's yours, right? And we talked about that. If you go to the gas station and you buy $60 worth of gas and you give them that $100, if they don't give you $40 back, you're going to be on the 11 o'clock news tonight. Am I correct? Right? So that's your money. Do you have to borrow the money out of your own purse? No. You just reach in there and get it. You get what I'm saying? So keep that in mind. So there's already an issue with having to borrow your money, but let's just say you had the $100,000 cash value policy. Okay, you had built up $20,000 worth of cash value in the policy. Things got hard, the pipes burst at the house, something happened, you had to borrow $10,000 off of your policy. You pass away the next day. How much is your family getting? $90,000, actually a little bit less because they're going to charge interest. Ain't that cold? They're going to still get their interest off of that, but let's be nice and go ahead and say $90,000. They're going to deduct that loan because you took that money out. Your family's going to get what's left over. How many things did you pay for? How many things are they giving you? Keep that in mind, okay? So take a look at this. And if that's not enough, the cash value policies tend to be more expensive. So take a look. We got John, who is covered for $150,000 in this example. We got Mary, obviously. We changed the names, right? So it could be Juan and Maria, right? Whatever. I'm not racist, right? I'm real. Okay, so $150,000 on each of them. So their total coverage is $300,000. How much are they paying in this example? $298 a month. Now, this is a couple in their in this example, 35. So they're in their mid-30s. Two things I want you to notice. Over here, this company covered them for $300,000 and $300,000. What this means is their take-home income is $30,000. Please write this down. Life insurance agents, don't write this part. I'll tell you when to start writing. I'm sorry, my bad. Life insurance agents love to make more money. Of course, that's what they do. They sell life insurance. So they want to sell you as much insurance as they can. So if John has a job where he makes $45,000 a year, and Mary has a job where she makes $45,000 a year. Sounds good. Well, after federal taxes, state taxes, union dues, this deduction, that deduction, they walk away with about $30,000. Y'all know how that go, especially if they're in California. That's why people move into Texas and Florida. You know, it's not like they like hurricanes and alligators. They move in there because there's no state taxes, right? So hear me and hear me well on this. So $30,000 each is what they bring home to feed their family and to keep the household going. The $30,000 is what they need to replace. So if John, because I'm too chivalrous to kill off the lady, right? So the guy got to go. So if John passes away, if Mary had a $300,000 policy on him, guess what? The 10% rule, 10% of $300,000 is what? $30,000. His income still keeps coming in. Now, hear me, ladies. A check can't keep you warm at night. I got that. Your boo is gone. You devastated. You know, as a Christian, you shouldn't be depressed, right? They always say that. But come on, we human beings, right? We can still mourn a loss and still go through all the stuff we have to go through, even though we know our partner or our person is in a better place. However, we're not adding insult to injury. Mary don't have to move out of the house and move into a studio with the kids. She don't have to sell all the cars and go to do the GoFundMe thing and all that, because when John was alive, he was bringing in about $2,800 a month. Do the math on that, right? Well, guess what? Now that John is gone, guess what's still coming into the house? $2,800 a month. So John's physically not there anymore, but at least his family is not devastated and the quality of life is staying the same. Does that make sense? So that's the amount of coverage that John needs. But the life insurance agent realizes if they sold them a cash value policy, there's no way that they can afford $300,000. You would have to double that number. That would be almost $600 a month. That family can't afford that. So then they gave them less coverage. So not only are they charging them more, they're charging them more for less. Okay, so here's what we teach people. We tell people, get a divorce. Now, hang on a second. I'm a married man talking about get a divorce. I know we're not supposed to say that, especially in church. What I'm saying is divorce your savings from your insurance. How many things are you paying for? Pastor is famous. Pastor Rayford Owens is famous for saying, stay in your lane. Yes, you should have some life insurance. If you still have more responsibility or more liabilities than you have assets, you need life insurance. I'm saying it. I'm telling you that. So your life insurance company needs to take care of the life insurance. But then when it comes to your savings, like we learned last week, see how this ties together? Your savings should be with an investment company, not a life insurance company. Not even the bank or the credit union, because at least it makes sense. If somebody went, ooh, I'm going to save some money in the bank, I'm going to be like, okay, you're going to get ripped off. But that's not unusual because that's what banks do. You're supposed to be able to save. They even call them savings accounts. The credit union is just a slightly gentler way of messing with you, right? But my point is, even though the credit union is an inch better than the bank, it's still not the best savings vehicle. But hang on a second. What I'm saying is, if your investments are separate from your life insurance, your investment company shouldn't know or care that you got life insurance. Stay in your lane. And your life insurance company shouldn't know or care that you got investments. Stay in your lane. So pastor, obviously he's talking about many different things, but that's where that wisdom comes from. You need to have that attitude when it comes to your money. Your life insurance company, if you die, pay my family. And don't charge me a ridiculous amount of money for that. And then with your investment company, if I die, here's the beneficiaries, say that beforehand. And if I die, you give them that. Your family needs to get both because you're paying for both. And both of those need to be under your control. So in this example, John and Mary are paying about $123 a month. Okay, do you see that difference there of $175? What is Greg going to tell him to do with that $175 difference? Save it for yourself. And then if you take a look with the calculator, which you should have because everybody downloaded it, right? Everybody did their homework. If you do the investment calculator and you do the compound interest calculator, $175 monthly, even at a 10%, I didn't even say 12%, at a 10% rate of return for 35 years, take a look at this. This is 600, can we just go on and call that what it is, 670? Okay, 670 by age 65. Now, hang on a second. This is at a 10% rate. How many ways does money make money? 3 ways. Y'all supposed to know that like you know your name. How many ways does money make money? 3 ways. What are they? Interest, capital gains, and dividends. Say it with me. Interest, capital gains, and dividends. This is just what? Interest. So do you think with capital gains and dividends over the last 35 years, this will be close to $800,000, maybe $900,000? But even if they didn't get no capital gains, shame on them. Even if they didn't get no dividends, shame on them. The interest alone would be $670,000. John, Mary, Miss Mary, do you still need to be paying, even though it's better, even though it's cheaper, do you still need to be paying $123 a month? No. You self-insured. If you pass away, your husband is getting $670,000. If your husband passes away because his boo just died and he died from a broken heart, that happens. You got to be careful, right? And if he can't, guess what? The family don't need that $600,000 because they're getting $670 here. And if they listen to me and got some capital gains and dividends, they're probably getting just shy of $1 million, at least $900,000. So do you see how when you know better, you can do better? It needs to be structured differently. Okay, so these are some of the rules. Now, this is kind of dark. It's kind of hard to see, but so am I. I'm kind of dark and hard to see, okay? So if you take a look at this, you got Bank A and Bank B. These are some of the rules that go on. Would you save any money? So your poor Uncle Joe died and left you 30 grand, okay? And you said, I'm not going to blow this money. I want to save this money. If you went to Bank A and they said that you might be able to get a 6% rate of return, okay, that's decent. But you went to Bank B and they said, oh, you can get up to 12% rate of return. Right now, which one would you go with, Bank A or Bank B? Bank B. Now, hold on a second. We got the Super Bowl coming up. Y'all seen some of them Super Bowls where the team was down 35 points and they came from behind and won in the second half, right? So right now, clearly Bank B, I'm not insulting your intelligence. Bank B is winning, but let's keep going. Now, they also said if you want to withdraw, you must take it as a loan. So in other words, if you want to touch your money, if you're in Bank A, you got to borrow it from the bank, not from yourself. They tell you from yourself, but look at the contract, okay? When you go in front of you're dead. When your family goes in front of the judge demanding the rest of their money, the judge is going to say, you know what, I feel for you. As a matter of fact, I guarantee you the agent didn't explain this to you, to your mom, or your dad before they passed away, but I'm sorry, I got to go by what the contract says. Is this your mom's signature? Yes. Or is this your dad's signature? Yeah. I'm sorry. Shame on you, company. I mean, the judge can literally admonish the lawyers for the insurance company, but still has to rule on the side of the insurance company. Does that make sense? So read your contracts carefully. Well, in Bank B, if you want to withdraw, there's no borrowing. It's your money. Just like Vanessa with her $100 bill in her purse. She didn't have to borrow that from the bank or from some insurance company. She had it in her purse. It was in her possession. She used it to buy her gas and kept it pushing, okay? And got her her change, so you're not on the news, okay? Now, let's see. Bank A, their third rule is the interest that you are charged on your borrowed money. Now, hang on a second. When you borrow money, you usually have to pay what? Interest to the institution you borrowed it from. Now, again, they'll make it sound like, oh, you getting a loan from yourself without running your credit report. Well, yeah, there's no running credit report because I'm borrowing from the contract, from the company. You get what I'm saying? Oh, you're borrowing from yourself. No, I'm borrowing from you. Because if I'm borrowing from myself, I don't have to pay it back, right? So, well, guess what? On top of that, they're going to charge you 6 to 8% interest. Well, in the situation with Bank B, you're paying a 0% interest. Why? Because it's your money. You're not borrowing it. There's no interest if you're not borrowing the money. Let's keep going. So right now, is Bank B still in the lead right now? Okay, let's keep going. The Bank A tells you we reserve the right to withhold your money up to 6 months. Now, a little hint, they probably not going to do that because they want you to borrow from it. They want you to get in trouble. They want you to pay them 6 to 8% interest. But let's just know in an emergency, if the economy crashes, if the stock market's down, if the company's in trouble and they don't want to give you this money for 6 months, they can hold up that loan for 6 months. 6 months later, if you needed it for a medical procedure that your insurance didn't cover, you could be dead 6 months later. You get what I'm saying? So let's keep going. And the other one, if you want your money, it could be direct deposited into your checking account, or you can have a check mailed to you within 3 days. So which one sounds better, Bank A or Bank B? Now, here's the one where even Christian folks have to tell the devil he a lie so they don't cuss by mistake. Remember, we in church, no cursing, okay? Number 5, we keep your deposits for the first 3 to 5 years. Let me say that again. You put in, let's say, $200 a month every single month in the bank. $200 every single month. $200. 12 months later, you're expecting $2,000. Just do regular math. I have this memorized. Don't be impressed. You've put in $2,400 into, call the name. I don't care. Bank of America, Wells Fargo, Citi, Chase. They chasing your money, okay? You got me? So you're putting in Chase $200 a month, every month for 12 months. You go up to the ATM and you want to withdraw some of your $2,400 and it says your balance is 0. Exactly. Rodney said, Okay, so then you go, oh, no, this is a mistake. Let me walk my happy self up here and stand in line and go inside the bank. You get up to the teller, and the teller goes, oh, yes, your account has not vested yet. You have a 0 balance. You mean to tell me I've been putting $200 a month every single month, and I'm cleaning up what you're saying, right? I've been putting $200 of my hard-earned money every single month into this, and you mean to tell me I got to wait 3 to 5 years before I can borrow some? I could borrow some of my own money? You would almost think that it is illegal to have these types of contracts written. But you know what? The insurance lobby in Washington, D.C., and in the individual state capitals are very powerful. In any other industry, this would be illegal. But read your contract. Well, of course, if you were doing it in Bank B, your cash accumulation starts right away. So if you put poor Uncle Joe's $30,000 in there, guess what? They credit the $30,000. Or if you're doing $200 a month, like in our other example, that $200 a month is building up immediately and earning interest, capital gains, and dividends, okay? Let's keep going. Number 6, if you want your cash accumulation to transfer to your beneficiaries when you die, guess what? You have to pay a little bit more. There's a fee for that. How many things are you buying? 2. How many things are going to give you? 1. Unless you are willing to pay $7 a month more, $12 a month more. I've seen even more than that for the privilege of your beneficiaries getting both upon your death. It's called level versus increasing. Increasing costs more, right? So whether it's the level amount, which is what it is, you have a $100,000 policy, or in this example, it was a $150,000 policy. You die, your family's getting $150,000. Don't ask me for no more, okay? Whereas increasing, they will add your cash accumulation to your death benefit and give both to the survivors. But now, is the company being nicer, kinder, gentler? Are they doing you any favors? No, you're paying for the privilege of getting the 2 things that you paid for. Keep that in mind, okay? And then finally, in Bank A, this program that you're getting, this savings account that you're getting, doesn't qualify as an IRA, an individual retirement account. Doesn't qualify as a college fund. Now, hold on a second. They're sold like that all the time. Well, you got some life insurance, but you got some savings for your retirement. Oh, you got kids. Let's put a life insurance policy on all your kids. And then when they're ready to go to college, they can borrow from the policy to pay for their books and their tuition and their room. Don't that sound wonderful? Well, hang on a second. First of all, why they got to borrow to buy the books? If this was a savings account, it should just be money in the account, first of all. In order to tap into that, they either got to borrow from it, or if it's been enforced long enough where it's vested more than 3 to 5 years, you get me? They will have that money available to them. But hold up a second. I always tell people, go to the source. Again, don't believe me. I could be telling you anything. Be like the Bereans in the Bible. Search the scriptures for yourself after you hear the priest say something. Call the IRS. I know y'all going, duh, not today, devil, right? The IRS, when you say that, people just get a chill down their spine and the hair on the back of their neck stands up. And yes, I know the IRS is ugly. They taking your tax money. I got that. But the IRS also is the federal government, and they do have some protection features. You can call them and ask questions. You can call anonymously, call from your friend's phone. Don't call from your phone, right? You can do that, right? When you call the IRS and you ask them, do cash value policies like whole life policies, Gerber, or like universal life or variable universal life, or any of these life insurance policies, do they qualify as a retirement account? They'll tell you no. A 401k, a 403b, a Roth IRA, a traditional IRA, those are legitimately recognized savings vehicles according to the IRS. College funds, it's got to be a 529 plan or a Coverdell account. You can also have a uniform gift to minor account. Those are the only thing that the IRS recognizes. So if your agent, I told you I'm going to make some people mad, and I apologize. I hope the agent ain't your cousin or your brother-in-law, whatever. Thanksgiving going to be mighty interesting. I understand that. But if somebody sold you a whole life policy or a universal life policy or an IUL, index universal life policy, and they sold it to you as a savings vehicle, they sold you a life insurance policy. The government does not recognize that as a legitimate college fund or retirement account or tax advantage. So let's keep going now that I beat that dead horse even more. Okay, money management mistakes that we make. Relying on life insurance through work or your union. Listen to me and listen to me well. Usually, like at the school district or at your job, they might have life insurance and they give you like 1 time your salary. I've even seen up to 5 times your salary, and they give that to you for free or next to free. They charge you like $3 per paycheck. If you get paid every 2 weeks, you paying $6. You are a part of the group policy. That's called group insurance. Write that down, group insurance. Here's the problem with group insurance from work. As my mother learned, LA Unified, right, represent, right, LA Unified for 31 years. Now, she already knew this because me and my wife were already in business. When she left LA Unified, when she retired, I mean, come on, she was 60-something years old. She should have retired, right? When she retired, guess what she couldn't take with her? The life insurance. Now, she still had her retirement. She still had her health care. I mean, they got a beautiful health care and dental and even vision. A lot of people, employers stopped paying for vision, right? But when it came to the life insurance, guess what? Doesn't qualify because she's no longer an employee. She stepped out of the group. Okay, so you have people who've, changed jobs. It don't even have to be retired. It doesn't have to be you got fired or something like that. They just moved from this job over here with company A to this job over here with company B because company B is paying $20,000 a year more. Shoot, you might move too, right? If they paying you $20,000 a year more for pretty much the same work, right? However, guess what? That life insurance that you were relying on for the past 12 years still stays at the old job. And if they don't have new life insurance over here or they don't have a program like that over there, you are now 12 years older. What happens when you get older to the cost of life insurance? It goes up. Or if, God forbid, you got a little diabetes, a little high blood pressure, so I'm not even giving you cancer or HIV or something like that that'll completely disqualify you. Even if your health isn't quite as good as it used to be back 12 years ago, it now costs a little bit more because you're in a higher risk category. You get it? They have, bean counters that look at all that. So this is what I tell people. If you have life insurance from your job, as long as it's $15 a month or less a month. Now catch that, a month. Because if it's per paycheck, you're paying $30 a month if you're getting paid every 2 weeks, right? As long as it's like $15 a month or less, keep it. It's icing on the cake. You there anyway. You get what I'm saying? Unless you planning on quitting and leaving, right? But you better have some independent life insurance for yourself outside of work. Get you a dirt cheap term policy that covers you. Yes, I'm sorry. Do you have a question? Go ahead. Oh, okay. You have get you a dirt cheap term policy that covers you for as long as you can qualify for it right now. We're going to talk about ending too soon, right? But if you get the right kind, this should cover you to age 100. Write that down, because people go, oh, no, that term insurance run out on you. You know, my auntie had it, and when she turned 70, that insurance went out on her. Well, your auntie had the wrong kind, and she was with the wrong company, okay? So keep that in mind. Also, watch out for this one, accidental death and dismemberment. That's a tricky one. Okay, it is what it sounds like. You better die in a plane, train, or automobile, usually common carrier. So Uber would count, you know, any taxi cabs. I don't even know if people have used taxi cabs anymore. If you're on an airplane, right? Okay. A lot of times your personal vehicle doesn't count, but even the ones that count your personal vehicle, why does it make the news when in a city the size of Los Angeles, I'm not even counting all the other counties, you got Orange County, San Bernardino County, Riverside, Ventura County. In Los Angeles County, somebody dies on the freeway. God bless them, God bless the family, but it makes the news because it's rare. You know how many millions of people are in the greater Los Angeles area, right? It makes the news. It's rare that somebody actually dies in an accident. But if you have $300,000 accidental death coverage, the agent might go around because they want to make that money and tell you, oh, you got $300,000 worth of life insurance. Yeah, but if you catch the coronavirus and you die, guess what? That ain't an accident. Your family don't get paid. If you get cancer, God forbid, and die from cancer, guess what? Family don't get paid. That ain't an accident. I'll go even more gangster with you and read your policies if you have one. With AD&D policies, a lot of times you have to die on scene or within a week of the incident. So let's say, God, I don't want to put it on you, but me. I was in a horrible car accident and my lung collapsed and they put me in the hospital and 2 months later I died from a collapsed lung. What does my death certificate say? Collapsed lung. It doesn't say accident. The death certificate, the cause of death was respiratory failure. That's what's going to be on my death certificate. Guess what? My family could go in front of the judge all they want, but he died in an accident. No, he died in the hospital. But it was because of the the judge ain't stupid. Why did my lung collapse? Because I was in a car accident. However, the policy said had to die on scene. And now that I say this, you've heard this stuff all along. Have you ever heard when they go on the news, victim died on scene? Okay. Guess what? Lawyers can use that as proof that he died on scene. But sometimes they'll say victim died en route. That's French. I didn't know that. Let me put my pinky out because I'm speaking French. En route, okay? E-N route, okay? En route just means in the ambulance. He died on the way to the hospital, okay? Or they'll say victim died at hospital. The reason why they're very careful to specify that is because those reports could be used in court to prove, oh, no, he died en route. It would have been better for with your last dying breath, you fought off the EMTs and just say, let me die right here, because you know your family not going to get paid if you die in that ambulance or you die at the hospital. Okay? Yes.
Reese on YouTube Facebook has a question.
Yes.
She wants to know, what about whole life insurance?
Okay. Whole life insurance is those rules that we saw, bank A, bank B. Whole life insurance is on, unfortunately, the bank A side, okay? What's happening there is the company is guaranteeing you for your whole life. That's why it tends to be more expensive, especially up front, right? For your whole life, they will guarantee you that you will get the face amount if you die. And on the surface, that looks decent. That looks good because that's what insurance is supposed to be. If I have insurance on my car, if my car gets totaled, you're supposed to pay off my car. However, unfortunately, with those whole life policies, you might be paying $100 a month for, and again, it depends on the age and the health and all that kind of stuff, but let's just go with a reasonably healthy 35-year-old. They might be charging you about $100 a month for $150,000 worth of coverage, where you should probably be paying from that same company. I'm not dissing the company. Notice I didn't call no names. That same company, because trust me, that's what they sell to their mama. That's what they sell to their friends and their family, right? If they sold them a term policy for that same $100, you would probably have about $400,000 to $500,000 worth of coverage. So those are the kind of things, and we'll go through that, on a one-on-one. I'm going to give my number again, and I'm going to give my email address again, and that's something we can Zoom about, like we can have a Zoom meeting with one of the members here, or we can do an in-person meeting, right? We can do that and go over that, okay? And if there's any other questions, please do that again, okay? Now, here's another mistake, relying on term insurance that ends soon. Now, this is what Auntie and Grandmama was talking about. They got a term insurance that was a 5-year term, a 10-year term. Okay, so what that means is what it sounds like. You got to be careful. You want a guaranteed renewable term. Okay, guaranteed renewable term. They're not coming after you for blood, urine, any kind of qualifications or anything like that. It's guaranteed renewable. Okay, it is what it sounds like, all right? So here's the point. Let's say you see one of these TV commercials and they go, ooh, a healthy male, age 40, can get $500,000 worth of coverage for $30 a month. They're not lying. That's true. But then when you read the fine print, hopefully you got a big screen TV so you don't have to strain yourself, right? When you read the fine print, it says a 10-year level term must convert to a whole life policy. There's that whole life again. So first of all, it's not guaranteed renewable. If you are going to, after 10 years, that policy is over. It's done. You now have to re-qualify for a whole life policy. Well, what if 10 years later you sicker? You definitely older, and you got to convert to whole life. What's the cost of that going to be? Okay? Hang on a second. I'm going to put my glasses on because I can't see. Ray is doing a great job of giving me, okay, thank you. Ray is doing a great job of trying to help me out, and I'm like, what? Okay, so be careful about that. I'll give you one, and I'll call the name, because I get it in the mail, and I'm sick of getting it in the mail. AAA, yep, that AAA, AAA. AAA, they got the nerve to actually send you the chart, and if you're between 25 and 30, you're going to pay this much, and then between 26 and 25, and between 31 and 35, you pay this much. They have the nerve to tell you that it jumps up in cost every 5 years, but no insurance after age 70. So again, at least it was guaranteed renewable because it was renewing you might say, oh, well, that one was guaranteed. It renewed every 5 years and I didn't have to take another test or have to reapply. That's true. But if it ends at age 70, but you happen to live until age 80 or 85, you see what I'm saying? Now you're in a pickle. Now, hopefully you've saved money separately, because remember, that was a term insurance, right? You've saved money separately where at 60, 65, you can go, you know what, I don't even need this anymore, okay? But be careful about that. And finally, a lot of times I run into this with young people, and I want to go, you're only 21 once. You're only 25 once. Trust me. When you hit that 50, you look back and you went from 35 to 50. I don't remember none of them birthdays in between, okay? So my point, even 40s, right? I don't even know 40s was a blur. My point is life insurance is cheaper when you're younger, okay? So now, yes, as a child, you should be on a child rider on somebody else's policy, save that money. But once you hit 18 to 25, in that age group, get your own independent policy. Okay, if you want to make sure you're not getting ripped off, talk to me. Okay, and I'm not going to just try to push the ones that me and my wife do. Trust we can. I've sat down with plenty of people from this church that already had a program for 6-7 years. It was at least the right kind. It was a term policy, and I could show them how to speed certain things up or focus on paying off their mortgage. They don't even need no new. I'm not trying to sell them no new policy. Okay, but my point is, when you are 25. That life insurance might cost you, let's say, $30 for $250,000. Just waiting until you're 30 to get it, now that you're married, now that you got a kid on the way or whatever the case might be, and now you're trying to get life insurance, that same $33 a month in this example, that same $33 a month is now $61 a month for the same coverage. So lock it in while you're young and you're healthy. Lock it away for decades, and you don't have to worry about that anymore, okay? So let's speed through this. Most people don't plan to fail. They fail to plan. So, that's what wealthy people have figured out. They do a plan, and they stick to it. Remember, that was one of the Proverbs that we went over last week. So review that from last week. Those of you who had the handout, it's in there. Now, here's another thing, counting on Social Security. Take a look at this number. Now, this is from AARP, so don't get mad at me, get mad at them. But they study this stuff, right? And they get this number from the government. Take a look. That's from the Social Security Administration, SSA.gov. I told you, any legitimate government website better end in .gov. That's the Social Security Administration.gov. The average Social Security payment, I know everybody got their little 5%. Was it 5% or 6% that we got, Social Security got a raise? Let's be nice and say 6%. What did we just find out today? They announced the new number today. If you don't believe me, go watch the news tonight. It'll be on there. The new inflation rate from January last year to January of this year, January just finished up, is at 7.85%. So what they did was the government gave Social Security recipients a 6% increase and patted themselves on the back like they did something. Last time I checked, 6 minus 7.8 is a negative 1.8. Their $100 bill still lost $1.80. Now, don't get me wrong. Thank God the government did the increase to help people on a fixed income, at least try to keep pace. But they're barely keeping their nose above the waterline. You guys are getting me? So here's my point. Can you survive on $1,543 a month right now? Imagine 40 years from now. And again, you might go, well, yeah, we're in Southern California. Nutbush, Tennessee, you can't live off of $1,543. No disrespect to Nutbush. Congratulations for having a lower cost of living, right? But that's still not any real money. So you want to make sure that your money is working for you so you're not in that situation in 2041, okay? So here's what we tell people, and this is where I'm going to end on this. I promise, Ray, I'm not rushing. This is, where I wanted to end anyway because this is where the program is. Look, we Christians, we know at this church, I don't know about other churches, but at this church, we teach the 10-10-80 rule. First 10% goes to who? God, that's his, okay? I'm not getting into I know we're under grace, we're not under the law, so it's not mandatory. We're not going to hell if we don't tithe, but trust me, you need to tithe because that's where your blessings come from. God knows he can trust you because you're not holding with a closed fist, okay? So the first 10% goes to God. The second 10% goes to who? Goes to you, goes to yourself. Now, I'm going to get in your face a little bit, and again, I'm going to run to my car and dive in, so in case somebody's chasing me, Rodney, you got my back, right? You don't let nobody beat me up in the parking lot, okay? How dare you treat the mortgage company with more respect than you treat yourself? Well, Greg, I got to pay my mortgage. I won't have a place to live. I hear you, but how dare you treat the light company, the light bill company, the gas bill company with more respect than you treat yourself? Okay? We're gonna go there. How are we going to pay? Your cell phone company. You gonna pay them before you pay yourself? Because let me tell you something. When you 85 years old and your money ran out, you're not gonna care that you had good reception 5G back when you were in your 30s. You're not gonna care that the lights were on back in 2022 because the lights ain't on in 2042. So this is what I'm saying. We got to be biblical about this. Yes, we need to take care of the next generations coming as well, but we need to take care of ourselves too. It's called the oxygen mask theory. Write that one down. You've all heard all this stuff all your life. The oxygen mask theory. Those of you who have been on an airplane before, when you get on, they tell you, what do they tell you? If the oxygen mask comes down, secure your mask first before helping somebody else. Because if you pass out, you ain't no good to anybody else. Now the flight attendant has to worry about helping them and helping you too. So especially to the parents like me and my 4 daughters, I know how it's good. I already know. Those masks come down, and I'm looking at my baby girls over here. The instinct is going to be, and try to take care of my kids. But the flight attendant will yell at me, sir, put your mask on, put your mask on. They're not being cold. They're not being cruel. They're not saying that they don't care about my kids, but my big behind need to put my mask on and breathe so I can help my kids and maybe some other people too. Does that make sense? Well, this is what that second 10% is. You got to take care of yourself. I know you got bills. I know you got student loan debt. Guess what? The student loan debt will still be there. I'm going to show you how to pay that off. You get what I'm saying? You have the tools in your hand. I keep doing this. My phone is right here. You got the financial calculators in your hand. We got the tools you need to get you out of trouble, okay? But if you're not giving the first 10% to God and the next 10% to yourself and then living off of the 80, something's wrong. And you're going to constantly be in that paycheck to paycheck mode, robbing Peter to pay Paul. At some point, you got to be like, I'm tired of this. Well, Greg, some of the bill collectors are calling. Let them call. That's their job. They getting paid to do that. Ain't their money. Well, she had an attitude when she called me. Don't pick up the phone next time. And you might go, well, Greg, that's not right. You're teaching them to be irresponsible. I didn't say you're not going to pay it, but you're going to pay who first? God, and then you're going to pay who second? yourself. And then after you pay your bills that's going to keep you alive, we're going to do the budget and try to find some money. If we can squeeze out some money for them, we'll take care of them too. Okay? Now, again, it might be controversial. Please don't tell Pastor I was yelling at y'all. Okay? So what we're going to do is we're going to adjust the priorities. We're going to budget. You know, we talked about that. You have the budget worksheet. That's this sheet right here. For those of you in the virtual world and those of you right here, take this seriously. This is how I'm going to find you money. I'm a financial detective. I'm real good at walking into somebody's house or getting on Zoom with somebody, and by the time I'm done with you, we done put $400 back on the table, $300 back on the table. I told you I'm your new best friend. Y'all didn't believe me. Okay, you will after we do the budget worksheet. You know, earn some extra income. You know, do some things, sell some things that's been in your garage for the last 5 years. If you haven't touched it in the last 5 years, you ain't going to touch it in the next 5 years. Even we just went through the lockdown with the coronavirus. If this was the time you didn't touch it, now that everything's opening back up, you still ain't going to touch it. Get rid of it. Make some money, okay? But you want to establish these 4 fundamental accounts. And this I am going to end on. I'm serious. I'm not rushing, Ray. I definitely want to end on this. You want to have these 4 fundamental accounts established, okay? And these 4 fundamental accounts are income protection. That's your life insurance. So remember, life insurance from work, icing on the cake. Get you some independent, dirt cheap term insurance outside of work. And please talk to me first, because this is what I do for a living. I read insurance contracts. This is not hateration. If you bought it from your uncle or your cousin, all I'm going to do is read it, make sure it's the right kind of term insurance, and they need to make the small little commission they're going to make on that. You caught that? That's why they don't like selling it, because they don't make as big of a commission. Whole life, to answer that other question, whole life insurance pays way more than universal life insurances, which pay way more than term insurance. So again, if an agent is too lazy or too unwilling to get their investment license to do things properly, selling dirt cheap term insurance and then doing the people's investments separately, then they got to make all the money they can off of the insurance. That's why they're pushing the more expensive stuff, okay? So get the right kind of life insurance. Remember, we call it income protection because you're really protecting that income so it keeps coming in. Set up an emergency account so then that way you're not dealing with the credit cards, okay? You'll see that. Those of you who are trying to take notes, you already have it on your paper here if you're live here, or if you emailed me, you already have this, okay? Then you want to put money away for short term. I call this fun money. Because all work and no play makes Jane a dull girl or Jack a dull boy, right? So you are going to want to go on a cruise. Quit playing. But guess what? When you on your cruise, you can enjoy your cruise and not worry about, oh, Lord, these bills are going to be waiting for me when I get back. That ain't no way to vacation. You paid for your cruise ahead of time. And by the way, how many ways does money make money? 3 ways: interest and capital gains and dividends. Guess what? Your interest and your capital gains and your dividends paid for that cruise. You didn't. You don't even have to touch the principal. Just skim off some of the capital gains that you earned. Skim off some of the dividends that you earned. Pay for your trip in full, okay? Your car, if you want that purse, if you want them boots or them shoes or that video game or whatever, it's okay. I'm not saying you can't have no fun and you got to save all your, no. This is the fun money. You just budgeted for it and you got some help, okay? And then finally, your long term. That's where we're dealing with your either traditional IRA or even better, your Roth IRA. This is for 80-year-old you. 90-year-old you. I always tell people, well, you can't take it with you. You might as well spend it away. That's the dumbest thing in the world. With modern medicine, you might live to be 100, 105 years old. If your money ran out at 80, what you going to do for the next 25 years? Work at Walmart? Have a nice day. I'm purposely trying to put that nightmare in your head because I want to make sure that we're not going to end up in that situation, okay? So finally, I'm going to give my number one more time. Most of you have it already. It's in the handouts that are here. My phone number is 562-416-1943. I ain't that busy. People go, oh, well, you got a wife, you got kids, and you got your business. I don't want to disturb me, please. I ain't that busy, okay? I get lonely. I want to talk to somebody, right? No, I just want to make sure you don't get ripped off, right? So call me. Let's set up an actual one-on-one in private so we're not discussing your information all out, right? Let's a one-on-one session, and let's put together a program for you. You might already have some or most of this already together. Let me tell you, no, girl, you got this going on. Don't you change nothing. No, here, tweak this over here. Now, tweak means don't change it, just make some adjustments, okay? Oh, you got a money market account for your emergency account? Great. Move it from your credit union over here to this investment company, right? If it makes more sense. Those are the kind of small tweaks, but who already had it set up? You did, right? At work, you already doing a retirement account. Oh, they're not matching. Okay, that money will be better off in a Roth IRA. You still gonna do the same amount. I'm not gonna tell you, oh, okay, take some of that money and go play with it. No, that ain't what it's for. This short term is your fund money, okay? This money is your Roth IRA money or your retirement money from work if they're matching, okay? So one more time, 562-416-1943, or you can go down in the paperwork that I gave. Well, I can actually go to that. Hang on a second. Let me Bam, there we go. And then there's the email address. I'll end on this. If online, you can go ahead and put this on the screen, and I'm going to go ahead and pray out, okay? So, tell Pastor I ended on time. I did not go over, okay? So please bow your heads. Lord, we're coming to you one more time. We're asking that you touch each and every one of us. We know that this was a lot of information, but we know that all of this is biblically based. We can see it in your word. We did our homework. We studied. We see that the world has just adopted your ideas, your directions, your corrections, right? Everything that you do to make sure that we have a prosperous life and that our kids and our kids' kids have a prosperous life. They've just borrowed from it, took it, twisted it to make more profit for them. We want to make sure that we're being good stewards of your money. We will bless you with our first fruits, our best fruits. You get the first 10%. We will make sure that we take care of ourselves, and then we will budget diligently with the other 80%. We will take care of all of our debts. We will not shirk any of our responsibilities, but we will do it according to your word and your will. Please help us. Please touch us. Please trust us with more of the assets that you have, because we are going to take care of that money with the right attitude, the right way, and we're going to teach that to our children, and we're going to teach it to our children's children so that your kingdom can continue to grow even after you call us home. This is what we pray in our Lord and Savior, Jesus Christ's name. Amen.